Welcome to Earnings Recap. Today we're covering the Walt Disney Company's earnings report and call.
And quite a bit to talk about this quarter.
Definitely. And right off the bat, a pretty big non-financial headline grabber. Disney announced plans for a brand new theme park in Abu Dhabi.
Yeah, that's their 7th one globally, and the very first in the Middle East. Quite a move.
It really is. So our mission today, as always, is to take Disney's second quarter fiscal year 2025 earnings report and their conference call and basically boil it down for you in plain English. We won't just throw numbers around. We'll explain what these results actually mean.
Right, and what you should maybe keep an eye on going forward. It's interesting that Abu Dhabi announcement sort of sets the stage, doesn't it?
How so?
Well, it signals their ambition for, future growth and totally new markets, even as we get into the weeds of their current financials.
Good point. It's that long-term view.
Exactly. Beyond just this quarter's numbers.
Okay, so let's look at those numbers. Q2 fiscal 2025 compared to the same time last year. Revenues first.
Sure. Revenues saw, pretty solid growth. Up 7% to $23.6 billion. That's up from $22.1 billion.
Okay, 7% top-line growth, that's healthy.
Yeah.
But the profit numbers, those really jumped out at me. Income before income taxes.
Yeah, that was the big one. More than doubled. It surged to $3.1 billion. Last year it was, $0.7 billion?
That's a massive improvement in profitability, isn't it?
It absolutely is. And, it connects to the bigger picture here. It wasn't just an isolated thing.
Right, because total segment operating income was also up significantly.
Exactly, up 15% to $4.4 billion. And then you look at earnings per share. Diluted EPS went from a small loss last year, like 0.01 cents, to a profit of $1.81 this year. Huge turnaround.
And the adjusted number, the one that kind of strips out some of the noise.
Adjusted EPS, yeah. That also showed strong improvement, up 20% to $1.45 from $1.21 last year. Really highlights the core operational strength.
Absolutely. It feels like, things are genuinely starting to click for them on the operational side.
It does seem that way. And it's not just a one-quarter blip either.
Ah, good point. You looked at the year to date, the first 6 months.
Yeah, the first half of their fiscal year versus last year. Same story, really. Revenue's up 6%.
Okay.
Income before taxes, get this, up 91%.
91%. Wow.
Total segment operating income up 23%. Diluted EPS, well over 100% improvement. Adjusted EPS up 32%.
Okay, so the momentum is real.
Seems like it. Even cash from operations saw a big jump, 70%. So, yeah, strong first half overall.
That context is super important. Shows this Q2 wasn't just a fluke, like you said. It's part of a pattern.
Exactly. A broader positive trend across the business.
All right, let's drill down a bit. Let's unpack the different segments, starting with entertainment. Saw a big jump in operating income there.
It did. Operating income increased by $500 million, landing at $1.3 billion.
So what's driving that? What's the main engine?
Well, the big story within entertainment is direct-to-consumer, their streaming business.
Finally making some serious money there.
Looks like it. DTC operating income hit $336 million. That's a really substantial positive swing.
And what's behind that swing? Higher prices.
Yeah.
More subscribers.
Both, basically. Subscription revenue grew because, yes, they charge higher rates and they added more subscribers.
Okay.
But it's worth noting that was partially offset by unfavorable foreign exchange rates.
Right, the usual suspect.
And also the absence of revenue from Star India now that the joint venture is done.
Okay. So that Star India piece is gone now. What about advertising?
Ad revenue was also up. They showed more ads, higher impressions basically, though the actual rates they got per ad were a little lower.
So more ads seen, but each ad worth slightly less.
Interesting. This DTC profitability is a big milestone though, isn't it?
Huge.
Yeah.
But, you've got to watch if they can sustain this, especially without that Star India contribution and with all the competition out there.
Good point. Maintaining it while still investing in new shows and movies, that's the trick.
Exactly.
What about the subscriber numbers themselves? Total subs.
Total Disney Plus and Hulu subs combined reached 180.7 million. That's a decent jump from the previous quarter. And that growth came from?
Disney Plus added subscribers, both domestically and internationally. And Hulu's SVOD only plan, the ad-free one, also grew.
Okay. And the revenue per subscriber, the ARPU, sometimes that tells a different story.
It can. For Disney Plus domestic, ARPU was up slightly. Probably those price hikes offsetting a small dip in ad revenue per sub.
Makes sense.
International Disney Plus ARPU was also up, kind of a mix of different plans and price increases, though FX rates softened that a bit.
Okay. And Hulu?
Hulu SVOD only, interestingly, saw a slight decrease in ARPU. Seems the lower ad revenue per sub there outweighed the price increases.
Huh. Okay, so a bit of a mixed picture on the ARPU front, depending on the service. Let's shift to the traditional side, linear networks, cable channels, basically.
Right, linear networks. Operating income there was actually up slightly, about 2%.
Only 2%, but revenue dropped quite a bit, didn't it?
It did. Revenue was down 13%. So yeah, definitely a mixed bag, like you said.
So how does income go up when revenue falls that much? Cost cutting.
Pretty much. The operating income growth came mainly from the domestic side, where they cut costs, marketing, programming, technology expenses were lower.
I see.
That helped offset the decline internationally, which again was mostly driven by that Star India transaction.
Got it. And what about subscriber losses versus affiliate fees? Are the higher fees making up for fewer subscribers?
For now, yes. Affiliate revenue, the money they get from cable companies, was roughly flat. The higher rates they negotiated managed to offset the decline in subscriber numbers.
But advertising revenue was down domestically.
Yeah, domestic ad revenue fell. Lower viewership and lower rates were the culprits there.
So cost cuts are helping the bottom line for now, but that top line pressure from cord cutting, that's still the big long-term challenge, isn't it?
Absolutely. You've got to wonder how sustainable that is long-term. They need to find ways to manage that decline or find new revenue.
Definitely. Okay, moving on within entertainment. Content sales licensing and other? Sounds like things are much better there.
Yeah, significant increases in both revenue and operating income in that part of the business.
What drove that? Movies, TV shows.
Mostly TV and video on demand distribution. It seems the timing of when they released certain episodic content really helped this quarter.
Ah, timing.
Also, home entertainment did well, boosted by Moana 2 apparently doing well on digital purchase and rental.
Okay. And theatrical, the movies and cinemas.
Theatrical distribution revenue was pretty comparable to last year. They had some carryover strength from earlier releases that balanced out how the newer Q2 releases performed.
And looking ahead, they seem pretty bullish on their movie slate, right? They mentioned a lot of big names on the call.
Oh, yeah. Management sounded really confident. They rattled off Lilo and Stitch, Elio, Fantastic Four, Mortron, Zootopia, and of course, the Avatar sequels.
It's like a packed pipeline.
It does, and they specifically mentioned learning lessons, particularly at Marvel, focusing more on quality over quantity now.
That's probably wise. Okay, let's switch gears completely. Sports. ESPN mostly. Revenue was up here.
Yeah, sports revenue increased by 5%.
But operating income went down by $91 million. How does that happen?
Costs. Higher programming and production costs were the main issue.
Why were costs up so much?
Mostly because they aired more high-profile games this quarter compared to last year. Specifically, 3 extra college football playoff games and 1 extra NFL game.
Those big broadcast rights aren't cheap.
Not at all. Plus, they had a write-off related to exiting that VNews Sports streaming joint venture they were briefly involved in.
Okay, so even though ad revenue was strong.
Right. Domestic ESPN advertising jumped 29%, largely thanks to that expanded college football playoff format and the extra games bringing in viewers. But even that big jump wasn't enough to offset the higher programming costs in that write-off.
So more games means more ad dollars, but also much higher expenses. A tricky balance.
It is. But they did say viewership trends for sports are generally healthy, and they sounded optimistic about the upcoming advertising upfront market.
And they're still moving ahead with the direct-to-consumer ESPN product, right? The streaming version.
Yes, they highlighted that and the plan to eventually bundle it smartly with Disney Plus and Hulu. That's a key strategic piece for them down the road.
Definitely one for you to keep an eye on. Okay, last major segment, experiences. Parks, resorts, cruise line, consumer products. How do they do?
Very well. Experiences operating income increased by $0.2 billion to hit $2.5 billion. This continues to be a real powerhouse for Disney.
Especially the U.S. parks, I gather.
Absolutely. Domestic parks and experiences saw 13% growth in operating income, and consumer products did well too, up 14%, driven by higher licensing, particularly mentioning the Marvel Rivals game.
So what drove the domestic park strength? Just more people showing up?
It was a combination. Higher volumes, yes, more cruise passenger days, higher park attendance, more occupied hotel room nights, plus strong Disney Vacation Club sales helped by the launch of the new Disney Treasure cruise ship.
And people are spending more when they're there.
Exactly. Increased guest spending per person was also a big factor. Now, this was partly offset by higher costs.
Right, inflation and expansion costs.
Yeah, expanding the cruise fleet, general inflation, those things added to expenses.
What about the international parks? I thought I saw a note about some softness there.
You did. Shanghai and Hong Kong Disneyland had a softer quarter. Lower attendance and higher costs were cited as the reasons.
Okay. But the outlook for domestic parks is still strong.
Seems so. They mentioned that future bookings for Walt Disney World for Q3 and Q4 are currently pacing ahead of last year.
And they're pouring a lot of money into the parks long term, aren't they?
Huge investments planned, over $30 billion earmarked for Florida and California parks to add capacity and enhance attractions. They emphasize guest experience and return on invested capital as the focus there.
And then there's that new Abu Dhabi park we mentioned at the start. Different model, though, right?
Very different. Disney isn't putting up its own capital. It's a royalty-based deal. They license the brand, provide design and operational expertise.
And collect fees.
Exactly. It lets them tap into that growing Middle East tourism market and its large income-qualified population without the massive capital outlay of building it themselves. Diversifies their geographic footprint.
Smart. Okay, so lots going on across the board. Let's talk outlook. What guidance did they give?
All right, for the next quarter, Q3 fiscal 2025, they expect just a modest increase in Disney Plus subscribers for the entertainment DTC segment.
Just modest. Okay. What about the full year?
For the full fiscal year 2025, they actually raised their guidance for adjusted EPS pretty significantly, now expecting $5.75.
$5.75. What was it before?
They didn't give a prior specific number in this release, but they highlighted it's a 16% increase over fiscal 2024. That's a strong signal of confidence.
Definitely. And cash flow guidance.
Also increased. They now expect $17 billion in cash provided by operations, though they noted that's partly driven by timing of some deferred tax payments.
Okay. And segment-specific guidance for the full year.
Entertainment. Expect double-digit percentage growth in operating income. Sports. Expecting strong 18% operating income growth.
18% for sports, even with the cost pressures.
Interesting.
Yeah. And experiences. Expecting 6% to 8% operating income growth for the year. Based on current trends, they think it'll likely be at the higher end of that range.
Okay. Any other specific call-outs for the full year?
A couple of things. About $200 million in pre-opening expenses for the Disney Cruise Line impacting results. And around a $300 million equity loss expected from that India joint venture.
A loss. Why?
It's due to something called purchase accounting amortization. Basically, an accounting charge related to writing down the value of assets acquired in the venture. It's a non-cash thing, but hits the reported equity line.
Gotcha. Accounting stuff. And they still put in the usual disclaimer about uncertainty.
Oh, yeah. Reiterate monitoring macro developments, uncertainty in the operating environment, the standard caveats.
And quickly, share buybacks. Still returning cash to shareholders.
Yep. Bought back $1 billion in shares this quarter. They said they're on pace for $3 billion for the full fiscal year. Okay. So, stepping back from the numbers, what was the overall vibe? The non-financial takeaways from the report and the call. Management tone.
Generally, I'd say optimistic and confident. They really hammered home the success of their strategic priorities, their focus on disciplined growth.
And what are those core strategies again?
Seems like three main pillars. 1, build streaming for growth, combine Disney Plus and Hulu, bundle smartly with ESPN, improve the tech, invest internationally.
Yeah.
2, maximize experiences, big investments in parks, international expansion like Abu Dhabi. And 3, renewed focus on content quality over quantity, especially, as mentioned, at Marvel.
Makes sense.
Yeah.
And how did the analysts in the market seem to react?
Well, the Q&A on the call showed analysts are definitely focused on the streaming strategy, park performance, and that Abu Dhabi deal. The market reaction seemed pretty positive, judging by the stock movement and the favorable press around the increased guidance and strong bookings, suggests investors are generally buying into the current story.
Okay, so let's try to summarize. If you had to list the key strengths and weaknesses highlighted in this quarter's report.
Strengths. Definitely the strong results in entertainment and experiences. The growth in DTC subs is a big positive. The ad market, especially for sports, seems healthy. The new cruise ship launch looks successful. Domestic park demand is robust. They're making significant future investments. And that strategic Abu Dhabi expansion.
Quite a list of positives.
It is.
And the weaknesses, the challenges.
Well, the drop in sports operating income due to costs and the write-off is a clear one. The softness they mentioned in the international parks, especially China. And, the ongoing challenge of making streaming a truly consistent, powerful growth engine, even though the profitability this quarter was good, it still feels like a work in progress.
Right. turning profitable is one thing, making it a massive growth driver is another.
Exactly.
So it's definitely a lot for you to chew on there, but
Yeah.
overall, it sounds like Disney had a pretty strong quarter.
Yeah, the report card looks pretty good for Q2. Strong financials and clear moves being made for the future.
Well, that wraps up our deep dive into Disney's latest earnings. Really fascinating, as always, to see how all the pieces of this massive company are moving.
It really is. And it definitely leaves you with something to think about, doesn't it?
Like what?
Well, think about those huge investments in theme parks and this evolving streaming bundle strategy. How might those big bets reshape the whole media and entertainment world over the next few years? And maybe more importantly for you, what could the ultimate impact be on the choices and experiences you have as a consumer?